This is Mike Wilkerson. I am the founder of Stormwall Advisors, the host of Stormwall.com, and the author of the book, Why America Matters. I'm coming to you on the 4th of August. This is the Stormwall Advisors monthly update, where we talk about all things around the economy, markets, inflation, geopolitics, and whatever else is going on in the world. If you are enjoying these programs, don't forget to like it on YouTube, share it, and subscribe to my YouTube channel. You can also check out all of my writings and videos at my media website, stormwall.com. Without further ado, let's jump right into this. I'm going to share my screen here if I can do this properly, and we're just going to go through a few of the highlights around the last few weeks and what we're learning about where we're going for the rest of the year. All right, so wanted to jump right into some of the recent news and events. July actually started out a little bit calmly. There wasn't a whole lot going on. Maybe everyone was on vacation, but in the last few days, there's been a lot of important information, a lot of news coming out. I wanted to talk about a few of the highlights, and just to give you a sense of where we're going, and make a few points here. Inflation still running hot, and energy prices are starting to rise again. And energy, as we'll talk about, has been the big driver of disinflation over the past year. It looks like that may be reversing itself. Big news that the market is ignoring for the moment, which is that the ratings agency Fitch has downgraded the U.S. No longer AAA, but now BB+. Does it matter? We'll talk about whether it does or not here in just a second. Related to that, I want to talk a little bit around the risk of U.S. government debt crisis coming more into focus, given federal deficits, total debt, and interest burden, which continues to balloon. The Treasury is issuing an enormous amount of debt now that the debt ceiling deal has been solved, or if not solved, at least put aside. And then I want to come back to talk a little bit about where we are with the banks and the markets in general. So first, onto inflation. So in July, there was a lot of rejoicing around the perceived disinflation that has occurred over the last 12 months. So a year ago in June, inflation had hit a secular high at 9.1%, now down to 3% with 12 months of pretty consistent decline. So a lot of talk around, okay, well, it looks like inflation's over. We can now go back to normal price levels, and the world is going on. What's being missed in all of this is the entire decline in the headline CPI number has to do with the price of oil. Like, energy price declines have driven the disinflation over the last 12 months. And yet high single-digit price growth continues in all other categories. But look, if you can see on the screen what's going on, oil prices down 40% from a year ago, when oil, at least West Texas Intermediate, was over $120 a barrel. In June, down below $70 a barrel. This is the story on this massive disinflation in energy, which drove the overall CPI number, the headline number of 3%. Everything else, transportation, shelter, both around 8%, services other than energy, 6%, food, just under 6%, electricity, over 5%. So these inflation, even though people are now starting to use the word transitory again, is being awfully sticky around everything else that's outside of the energy complex. And in fact, I think we need to take a time out and just talk a little bit around the narrative here that inflation is coming off and we're back to normal. The reality check here is, if you look over the 3-year period where we've seen inflation from June of 2020 until June of 2023, in total, when you take into account the base effects of compounding that's occurred over 3 years, fuel oil up 82%, gas 71%, cars, used cars 47%, transportation 30%, electricity 24%, food 20%, headline number compounded over 3 years 18%, shelter 17%. So these are the real prices, at least as far as CPI is concerned. Whether CPI is real or not, we've talked about in other programs. But even with their numbers, with the Bureau of Labor Statistics numbers, we are paying way more. Pocketbooks are being squeezed considerably as a result, and wages, while starting to catch up, have not nearly caught up with these price increases. So this is the reality. Great to see headline numbers coming down. Great to see disinflation over the last 12 months. I don't think we're out of the woods yet. And in fact, the challenge that we have now is that energy prices, which I said were the drivers of the deflation, through June are now starting to rise again. And this inevitably will push inflation higher, not for July CPI. This is really something that is coming in later in July, not going to be picked up in the July numbers. But we start to see it that now gas prices at the pump at highest level that they've been since November of last year, up some 25% from the trough from the very bottom in December. And oil, which was really the driver, of course, of all of these other things, was down below $70, as we talked about on the last page, now up again above $81. And this is going to flow through into energy prices and into the inflationary complex, because energy itself drives other factors, food and transportation being two of the most obvious. So I continue to expect that we're going to see a reversal in inflation trends and see prices start to move up again. And in fact, if you look at some of the categories, you can see it, that inflation is actually locked in for the next couple of years. Here's a little anecdote and illustration for New York City residents, Westchester County residents, basically the New York metro area. Just last week, the New York regulators approved very substantial price increases for both electricity and piped gas into the home through the service provider Con Edison. So if you're a resident of New York, either city or the suburbs, you can expect your prices are going to continue to go up another 15% through 2025, 2 years from now. And if you are fortunate or unfortunate enough to be using gas to heat your home, your prices are going to go up 23%. Now, this strikes me as a bit odd, given that natural gas prices are actually falling and have been falling over the last several months. We know that New York City politicians are not in favor of gas stoves, gas cooking, gas heating, anything like that. So one has to ask, is this intended to be a bit punitive or a disincentive for developments that include gas into the home? Nonetheless, inflation is guaranteed right here by the regulatory price increases, at least in this one area. I will note that in Florida, Florida Power and Light has recently reduced the cost of electricity by around 6% on average, reflecting the lower natural gas prices that are used for a lot of their power plants. So different trends going on in different parts of the country, but you can count on this bringing about further inflation. And before we start feeling too sorry for ourselves here in the US, it's important to always remember Europe is faring much, much worse. So we saw again June CPI 3% in the US. Spain, whose electricity is largely powered by wind and other sources and have some degree of energy independence, the one country below the US, you see a predictable trend here that the countries which were or are most dependent on Russian gas are faring much worse than those who aren't. The Euro area on average was at 5.3%. This is for the preliminary statistics for July. And places like Austria, Germany, and Italy, which have a significant dependence on Russian gas, are faring much, much, much worse. The UK, not part of the EU anymore and not dependent on Russian gas, they're also experiencing pretty significant inflation. This is a June statistic of 7.3. So it's bad here, but much, 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 much worse in Europe. I want to move on and talk about the US debt situation. So the pretty substantial news coming out of this week was ratings agency Fitch downgraded the United States from AAA to AA+. This is the second time that a rating agency has downgraded the US. The US was also downgraded back in 2011. And Fitch pointed to a number of things. Basically, they said, we see expected fiscal deterioration over the next 3 years. We don't see a plan to address it. We see high and growing levels of government debt burden. We see deteriorating credit quality, and we see erosion of governance, the inability for Congress to make decisions, come to agreements, debt standoffs, last-minute resolutions. And interestingly, Fitch also projected the U.S. would be in recession by the fourth quarter or the first quarter of 2024. Now, this news, the Biden administration came out pretty hard against it, saying that the data were flawed, the information on which they made the decision was flawed. One administration-related person on the campaign blamed Trump, saying that it was Trump and January 6th that caused all this to happen. So not surprising that the narrative keeps turning back to the former president and to January 6th. Largely, the market ignored it. This did not seem to get a whole lot of reaction from anyone, so it's not surprising. Let me see, I just jumped ahead. So I wrote about this a couple of weeks ago, that the alarm bells are basically being ignored. So we saw a ratings downgrade. We've also seen the national debt grow from 31.4 billion at the end of last year to 32.6 billion now. I called it out, talked about it the day before the ratings downgrade announcement. Following day after the downgrade, the Wall Street Journal picks up a similar theme. Basically, the idea of both articles is that we keep going deeper and deeper into a hole. No one seems to be noticing or doing anything about it. At some point, the music ends. What do we do about it? I've shown this before, but just as a reminder, this is being driven, the debt bubble is being driven by the federal deficit, which is completely unsustainable. We've now accumulated nearly $21 trillion in cumulative deficit since 2001. Now, if we were funding deficits in some other way, for example, tax revenues, well, it wouldn't be a deficit at that point, but the only way the government is funding deficit is by turning those deficit balances into newly created debt. And at some point, the gig is up. You cannot keep spending into forever. I've shown this slide before, but the United States is now more leveraged than it ever was during the global financial crisis. Household debt has come down, but federal debt has ballooned to about 120% of GDP. State and local governments adding on top of that. In aggregate, total debt in the US is roughly 257% of GDP, and that's before entitlement things like Medicare, Social Security, and others that aren't included in the debt balances. So we're actually much worse off than we were during the financial crisis, and it's really government that's driving this. So if you look at, I mentioned that the national debt is now 32.7 trillion. But what's interesting and very troubling is that given rising interest rates, so the Federal Reserve raised interest rates again by 25 basis points this month in July. The federal government is now projecting interest payments of $1 trillion. So way, way, way more than what it was before, when we were in a period of very low zero interest rate policy, monetary policy. The debt burden wasn't that bad. You see, just from 3 years ago, the debt burden, the debt service burden, just paying off the interest has nearly doubled. Now, in order to fund all of this, hang on, I'm having some trouble clicking around here. Let me see if I can go back. There we go. The U.S. Treasury announced that they are essentially going to be flooding the bond market post the debt deal, that they need to do about $2 trillion of refinancing by the end of 2023 in order to both refinance old debt, but then also to fund these ongoing deficits. So in May, right before, in June, just as the debt deal was being sorted out, the U.S. government almost ran out of money. So basically, the U.S. Treasury general account, this is where they pay all their bills, had been up at $800 billion right before this slide starts, back in May of last year, and dipped down to only $44 billion in June. This was the lowest level seen since 2017, which I believe was the last stalemate standoff. And the Treasury would have run out of cash within days. Now they have begun to replenish the coffers back up to around $550 billion. They raised that debt here in the second quarter. You see this number here, 657 billion that was raised in the second quarter, but now projecting over $1 billion in the third quarter and 852 billion in the fourth quarter. So the implications of this are that the yields are going to go up. It's going to require higher yields to attract buyers to this massive wall of debt. If those buyers aren't there, we're going to see monetization by the Fed, which means that the Federal Reserve, the central bank, will be buying its own government's debt if the market can't support these levels. The Fed did this in 2020 during lockdowns, during the pandemic, basically doubling its balance sheet from 4 billion to 8 billion during this time. That has implications for the banks, who are still in trouble, even though we've had a quiet period over the summer. With those treasury yields approaching 5%, bank deposit funding simply cannot compete with either treasuries directly or with money market funds. And if they try to raise their deposit rates to match, banks will face pretty significant losses. Now, at the same time, banks are sitting on a record amount of unrealized losses from commercial real estate, and they're being forced to tighten their credit. The impact here is that they're kicking the can down the road on these losses, not realizing them because they have no ability to raise new capital. But this is one of the most significant issues facing not just the banks, but the economy as a whole. Vacancy rates in commercial real estate in the big cities are in double-digit levels, and we're seeing defaults increase every day. One of the most telltale signs that the banks are still in trouble is that they continue to draw heavily on the Federal Reserve's emergency funding lines. There's several different kinds of programs, including the Bank Term Funding Program that was put in place in the wake of Silicon Valley Bank's failure, other programs. And while it's come down from its peak, the banks are still borrowing over 250 billion from the Fed. It's down from 325, but normal is zero. Okay, you see back here in the pre-Silicon Valley Bank period, it was only banks that were truly in trouble, one-off idiosyncratic situations that were actually borrowing. The rest of the banks were relying on their deposit funding. That came to a halt with Silicon Valley Bank in the aftermath, and the market has not normalized. So we do not have a functioning market right now for bank liability funding. And I have shown this before, but I just wanted to keep in view that although it's been an incredibly quiet summer, there's not been a lot of news around the banks. Let us not forget that it was 6 months between the collapse of Bear Stearns weekend in March 2028, and Lehman's collapse 6 months later. And so let's just turn now to what's happening in the markets. The markets seem completely detached from what I've just been talking about. We've had a very strong equity market year to date. The best performing has been the FANG stocks and tech stocks that are related to artificial intelligence, which has become a new meme, a new bubble-like trend. And so you see here that the FANGs and then the NASDAQ, which is QQQ, up very positively. The other big performer has been crypto, Bitcoin, and Ethereum as the top performing asset classes along. So everything related to tech has done quite well. The broader markets, S&P, small cap Russell, have not done as well. And interesting, the commodities have basically been flat, as has the dollar. Bonds have been down slightly and flat. And the banks, as we've been talking about, have come off of their lows, but are still down significantly. Now, this is year to date. It was through yesterday, through August 3rd. In the last few days, we have seen significant weakness in the equity markets following the Fitch announcement, following other developments in the markets. And so I think we're seeing a shift here in sentiment. We had a very momentum-driven market, and it was very narrowly focused on, as I described, on those tech companies. You did not see broad performance across categories. The growth in the equity markets isn't related to what's happening fundamentally. So corporate profits are down, earnings growth is decelerating. We've had 2 quarters of negative profit growth in aggregate for the US, but valuations have gone up. So in January, at the beginning of the year, price to earnings ratios, the ratio of how much you have to pay for a share to acquire $1 of earnings today, went up to 31 times from 28 times over the past 6 months, which is basically one of the highest levels we've seen. We had a peak around 2020. We had the dot-com bubble back here in 2000, but this little stretch right here, we see rising prices. At the same time, the employment data that's coming out is very confusing, very misleading. A debt here to Zero Hedge, who's been hawking this issue over the course of the year. But one of the things that Zero Hedge points out is that the job numbers have been consistently massaged downward. Initial estimates of job change, final numbers have been down every single quarter. And digging further down, jobs are not jobs. You can't count them all the same way. Full-time jobs, June to July, down substantially, replaced by 2 part-time jobs. I'm not sure that indicates economic strength or employment strength when someone is let go from their job and has to work 2 part-time jobs or multiple jobs in order to make up for it. So I want to wrap up. I want to talk a little bit about some of the takeaways from this monthly update. the first thing I would say is just let's speak. Let me start where we ended, which is to say, be very careful in this market. It feels like equity markets have gotten overblown. Risk skews down to the downside, in my view, in the second half. And as I've consistently said, I do expect inflation to pick back up in the second half, really driven by these energy price increases, the reversal in the trend on oil and otherwise. The government debt crisis so far is largely being ignored by the market. The Fitch downgrade resulted in a massive shrugging of the shoulders. But at some point, the game will be up. At some point, investors, the market is going to have had enough and not going to be interested in acquiring more U.S. debt at any reasonable price. When that moment comes, it's going to be disastrous and have significant complications for the markets and for the economy as a whole. A related crisis is my view that the banking crisis is not over. We may have another round of failures. If you haven't taken any action in regard to your own banking, it may be a time to think about it, but be aware that the next shoe may be yet to drop. Related to the banking crisis is the tightening credit standards. Banks are just not lending as much as they were under these conditions, given the state of their balance sheet. This means that economic growth will be constrained, especially for Main Street economies, small and medium-sized businesses and otherwise, which in turn leads to another conclusion. And Fitch said this, we mentioned already, that I still see recession by the end of 2023 a possibility. There's been a lag effect as all of these things have come in, higher interest rates, tightening credit, debt overload. But even with a lag, this is still likely to happen. So let me go ahead and stop the share, close out with just a few words to say. Hope you found this helpful. We'll be back next month talking about some other issues that seem to be emerging over the course of August. It's been good to be with you again. If you've benefited from this, like it, share it, subscribe to my YouTube channel here, and check us out at Stormwall Advisors if you want, stormwalladvisors.com, if you want to learn more about what we do to provide services, strategic advisory services on key issues around the economy, around corporate transformation, merger and acquisition, geopolitical issues, etc. Good to be with you, and we'll see you next time on the Stormwall Advisors Monthly Update.